Hello everyone and welcome back. In this video, I want to talk about 5 mental biases that cost you more than 10% per year, that cost you your performance. 5 bad mental habits that prevent you from achieving a better performance. So I believe there is a delta between being a mediocre investor and a good investor, a mediocre performance and a good performance, a 10% delta. And having bad mental habits is the cause for underperforming the market. And what is great is that's easily fixable. And in this video, I want to talk about 5 mental biases and what you can do to remove these bad situations, these bad emotions, and having the right framework to improve the quality of your holdings, the quality of your performance, and finally outperform the market. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And the goal with this YouTube channel is to help you become a better investor. So avoid bad, negative emotions, bad habits. The first one being the confirmation bias, where you only read things that agree with your stock pick. This is something very common, especially in the internet. Now you are probably aware that the world is becoming more angry. People have become more impatient online, and people don't like to disagree politely. If you go to Twitter, be careful, because you will find an angry place, a very mean place. People don't like when people disagree with them. So people like to only read what is positive and that suits their style. People only read what is confirming their own existing thesis. It's normal, we are all humans, but in investing, you don't need this. On investing, you don't want confirmation bias. Actually, you want the reverse. In investing, you want to know what is good about a company, but also what is bad about a company. So when you buy a stock, you want to know what can destroy your thesis. So you can know, you can see in advance, okay, this is a red flag I have highlighted in the past, a red flag I know, maybe the ship is turning directions. When you invest, when you pick a stock and when you invest in a stock, you want to know the top 5 things that are positive about a stock and the top 5 things that are negative, okay? So you can know what is more important. If you prefer the 5 positive things, you think it's more important, you invest. But you always have to monitor what is bad. You always have to monitor the risks, because maybe one of these 5 risks will come in reality. Maybe the situation will change. The business will face a clear difficulty. And if you don't know these 5 things to monitor, you will be surprised. And it will be too late, because there will be a shock and the stock will drop by 20%, boom, because of a bad earnings report, okay? You have to know the opposite thesis. You have to know the bear case, what can go wrong about the business. But for some people, they don't do this. They only look at confirmation data that is very good, only positive to the stock price, to the company, wonderful, 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 and then you get a huge surprise. So confirmation bias is something that is very simple. When you want to invest in a stock, you open Gemini, you open ChatGPT, and you say, okay, I want to invest in this company. Tell me the 5 key risks to monitor. Tell me the bear case, the bear thesis. Tell me the opposite thesis, okay? What can go wrong? And Gemini, ChatGPT, any LLM will do the work for you. You don't even have to do the homework yourself. Either you do it yourself, or you can just ask Gemini and it will work out okay. Okay? You will find data that will show you that it's not a great investment, that you have a lot of risks, etc., etc., etc. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Second point, another mental bias that is costing you your performance is loss aversion. You hold losers to get your money back and you lose more. Maybe you have this in your portfolio, a stock that went down minus 30%, and you say, I'm not selling now because I will sell when it rebounds. When I'm at break even, I will sell again, so I will not lose money. Guess what? It's a mistake. Because first, you don't know if the stock will rebound. You don't know when it will rebound. Maybe because you don't know what are the elements that will make the stock go up again. 2, if you hold to a loser, it's quite unlikely the stock rebounds. Actually, if the company is losing steam, if the company is deteriorating, it's more likely that the stock continues to go down. So you will lose even more. 3, it's an opportunity cost. What if you have a stock that has declined already, minus 30%. You sold today, you sell now, and you buy something else that is winning and that is growing. I know this, I've done this in the past. You cut the losses of losing positions. You buy other stocks that are cheap. And in the meantime, the stock that was cheap is going up in value. So instead of hoping that you have a rebound for your losing company, you change cars, you change boats, you invest in a winning boat, and then the stock goes up. I've done this many times in the past, and it's better. Mentally, it's easier to just change ships, to change cars. It's much easier, okay? And very few people are doing this because they say, okay, you know what, let me wait a little bit, I will sell when it's at break even. It's painful to sell a position, but sometimes it's the best possible scenario. You cut your loss, you say, okay, I was wrong, the business is not as great as I thought. You cut the loss and you invest elsewhere. The opportunity cost is great. Because I'm telling you what will happen if you don't cut the position and the business keeps deteriorating and deteriorating. The 30% loss will become 40% loss, 50% loss, 60% loss, and you have just wasted your time because you could have cut the position and invested elsewhere to a winning company. But it's difficult mentally to cut the position. I'm telling you, most of the time is the best possible thing to do. Cut the loss. Move on. Okay? You have plenty of opportunities, plenty of fish in the same pond. Just cut the loss. Move on. You have better opportunities in the market. If you think the fundamentals are deteriorating, move on. This only works when fundamentals are deteriorating. Maybe it's a simple re-rating. Okay? So this situation of moving on and changing the company only works with companies that are getting bad, frankly deteriorating, fundamentals are down, margins are down, it's a mess, you don't have any certainty, you have many risks at the same time, the management team is suffering and panicking. It's bad, just move on. It's much easier like this, you just move on to another position. But this fact that you are holding too strong to losing position is costing you your performance. You're just waiting because you don't want to move on. Third point, anchoring. You wait for the stock to return to your buy price before acting. Something that happens too often. Actually, I had a call with a client yesterday and we talked about this. He opened a position and it was a tiny position. He did not go full force and buy a full position. So a tiny position, opened the position a little bit because the stock dropped. And he said, I want the stock price to drop more. And then the stock rebounded plus 3%. And he said, I'm not buying anymore. That's it. It's too expensive for me. Guess what? The stock continued to go up and go up and go up. Not because of nothing, but because the earnings improved. So you had new headlines, the stock went up because fundamentals improved, the business went better, and the business didn't go up by 20%. It went up by 3%. But the client said, no, it's just too much for me, too high. And we discussed this. It's a mistake to have this price anchor. If the business is getting better, it deserves a better price, a higher price. So actually, averaging up is sometimes the best thing you can do with your portfolio. If the business is improving, if the fundamentals are getting better, averaging up is actually very smart, okay? And it is not happening for all the scenarios, all the stocks, but for this exact scenario, it was the best possible move, okay? And many times in history, you will see that the best investors of the world have averaged up because winning companies keep on winning. But it's difficult mentally to have this recurring effect, and then you say, I have this target price in mind, and if it rebounds, I will not buy more because I want a great price. People are greedy, it's normal, it happens very regularly. 4. Recency bias. You panic after a red week and sell great companies. In a world with uncertainties, in a world with the geopolitical risks, people look at the past week and they say, oh, this is bad. The past week was bad. The news is bad. The headlines are bad. So it will be bad for the remainder of the year. It's not true. It's just our brain that works like this. You think that the most recent things will continue. Yeah, actually, if you look at the past, it's not true at all. Or everything is temporary. And the best moment to buy is when you have negative headlines, when people are freaking out, when the uncertainty is at the maximum level, when the pessimism is at the maximum level. This is when you buy. But as always, people panic, people are led by their emotions, and when they see red days, negative headlines, they freak out, they freeze, and they do nothing. It is a mistake because you do nothing when you have a golden opportunity to buy the dip. So this recency bias, this freezing model prevents you from having the best deals. It's Christmas, you have discounts. You want to buy when things are cheap. You want to buy when things are dropping. But the fact that you are freezing and scared, actually you are scared, prevents you from achieving a better performance. Because it's when you have the best deals, when you buy, when you have extreme panic, that you outperform the market. And this delta accumulates. A little bit of confirmation bias, loss aversion, occurring, recency bias. This accumulates, this compounds, all these negative things compounds, and it amounts to 10% difference between people that panic and people that are rational. A fifth element is overconfidence. You think you're doing well, but you've never measured it. For example, how can you know if you are lucky or good? How can you know if you are lucky or competent? It depends. Over a 6 months time frame, stock prices mean nothing. People on the internet are short-term oriented. If you are young, like below 50 years old, you have an attention span that is reduced. I'm part of the equation also. So you tend to measure yourself on a short-term basis. People look at the 6 month stock price and they celebrate too much. Actually, that's a little bit short. Fundamental investing is investing for the long term. So you never know if you are lucky or you are confident. And some people look at the stock price over 1 month and they celebrate too much. They are getting overconfidence, but it's pure luck. It is a mistake. Only judge the businesses based on fundamentals. If the revenue is improving, if the earnings per share are improving, if the free cash flow per share is improving. Stock prices in the short term, completely irrelevant. Completely irrelevant, that's just luck. Over several years, you can judge if somebody is good or not. I would say over 2 or 3 years, you can judge if an investment was good or not, if the fundamentals have improved and the stock price have improved. Over 3 years is a good way to see if this was just luck or not. But some people judge themselves on a short-term basis. They think that they are too confident, too good, and that's exactly when they fall. They have too much risks on their portfolio. They have a portfolio that is high beta, risk on, leverage, and overconfidence kills you. You don't need leverage to outperform the market. You don't need to be a genius. You need discipline. You need the right framework. So there is a fix to all these mental models that prevents you from beating the market. All these mental models are costing you, on average, 10% performance every year. And that's a lot. So the first fix is to build a checklist that protects you from your brain, from your emotions. A checklist for evaluation, a target price, for example. A checklist for having a specific price and you have to buy at this price. Or a checklist to see, okay, am I being impacted by negative headlines? Is it just emotions at this point? A checklist is the way to go. You have to act as a pilot. All the pilots go through a checklist before taking off. And as an investor, similarly, checklist will help you make strong, rational decisions. 2, use decision journaling to track why you bought and why you sold. It's really good to write down why you are buying something. I'm doing the same thing on YouTube. Instead of writing down the things, I'm doing videos, why I buy this, why I sell this, so I can document the journey. Documenting the journey and just explaining by your voice or by your words why you are doing this is a great way to rationalize an investment thesis. Because if you put words, you will know if this is emotion-based or rational-based decision, okay? So you will know exactly what are the 3 reasons why you buy, what are the 3 reasons why you sold, etc., etc. 3, shift your focus from emotions to a clear framework with discipline. This is the goal of investing the Warren Buffett way. You use a right framework with discipline, a right process to avoid these bad mental biases. And if you know yourself, if you invest in a rational way with discipline, and if you avoid these 5 mental biases, you will improve your performance by more than 10% per year, and you will finally outperform the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.